You know, just about a week ago, your colleague, Scott Kleinman, told me that a recession could come by the middle of next year, early next year, and last a little longer, around 6 to 9 months, given that this would be a Fed-induced recession. Now, given that kind of an outlook, David, are you preparing for any distress? And how are you seeing about how this might play out in the investment universe?
Good question. First of all, thanks for having me on again. You know, I'm not prepared to prognosticate. I like to always say our job is to prepare, not to prognosticate. Clearly, financial conditions are getting tighter. You're seeing the stock market pull back tremendously. You're seeing rates go up. You're seeing spreads continue to widen out a little bit. I think we are preparing, whether it's going to be 6 months, a year, 2 years, it remains to be seen. But no matter how you slice it, financial conditions are tightening. And as borrowing costs are going up, companies are going to struggle to service their debt. And there's never been more corporate debt in the history of America. Companies are going to struggle to meet their covenant obligations. And companies are going to struggle to repay debt when they come due. So we are preparing for distress, but I can't tell you exactly when we expect it to happen.
Maybe expand on that a little bit more, David, because to your point, over the last couple of years, record amounts of borrowing here. And you had a big play on when it came to the return to office play, the return to the economy play. What sectors, what areas of the economy are going to see the most pain as we get off the support of the Fed?
It's too early to tell exactly which sectors will be impacted, but every sector will be impacted by higher borrowing costs. It's impossible not to be. As you alluded to, the answer for almost every crisis we've had over the last 10 years has been lower rates, lower borrowing costs, and indeed more debt. And the way that most companies got through COVID was by issuing debt to buttress their balance sheets and ride through all this volatility, which some companies are still dealing with. So I think it could be companies that, you know, we're in the leisure and hospitality space, which are doing quite well, but have issued so much debt that they just simply won't be able to grow back into their over-levered capital structure. Yeah. I think it'll be a lot of industries, and history has shown whenever rates gap out, whenever spreads gap out, it starts in one area. It could start in energy, it could start in hospitality, but it quickly spreads to almost every corner of the economy.
So, David, I am curious whether, or in overall, do you think that there's going to be, that this will contribute to a significant slowdown in deal volume, whether it's in the total number of deals or in the aggregate dollar value of those deals?
I think overall it has to, right? And I think that, you know, everyone was predicting this. If you look at last year, it was a record in retrospect in terms of M&A volumes. It was a record in terms of public stock market valuations. And you've seen a pretty quick retrenchment. My expectation is that deal volumes will come down. Normally, M&A volumes do track the stock market. The stock market's down. You would expect traditional M&A deal volumes to be down. We've been quite busy. I think we're a little bit different in that we're somewhat counter-cyclical. So when markets pull back, we lean in. We had almost a record-breaking first quarter, 5 deals, a little over $4 billion of equity committed out of our $25 billion flagship fund. So I am expecting overall M&A volumes to go down. Financing's less plentiful. Stock market and valuations are down. This should be a good time to invest, but because of the inability to finance deals and because of concerns about where the economy is going, people do normally pull back in these time periods, as you said.
And so what do you say to investors who've been diversifying, getting into private equity, looking at committing capital? We had Mike Novogratz on a little bit earlier saying everyone's got into all of too much, and then that's why we see these correlations so happening and everyone pulling out of every area of the market all at once. What do you say to steady the nerves to say, look, remain committed, and in fact, perhaps more capital to work in private equity?
Well, you are seeing a rush of capital into all private markets, whether it's private credit or private equity. I think there's a lot of advantages to it. I'm sure that won't surprise you that I'm saying that, but I think you got to be careful. I think so much of private equity has not been the traditional type of private equity over the last 10 years. Everyone's really been pursuing the same growth-focused, long-duration equity that's been resonant in the public market. 50% of private equity deal volumes over the last 24 months have been tech and healthcare. So there's not a lot of diversification in private markets, just like there hasn't been in public markets. And I think as public markets retrench over time, you're going to see these very long duration tech and healthcare focused private investments also run into problems.
You know, I'm kind of curious about the inflationary impact on the portfolio that you already have. When you look at the way inflation is hitting these companies, David, does it make sense about the course that the Fed is currently on, or do you think that there needs to be something more drastic to cool the inflation that those companies are feeling?
Well, inflation's real, and we're seeing it across the portfolio. Much like in public markets, though, even though inflation's real, you are seeing companies continue to grow earnings. So you've seen positive EPS for the public markets. We've seen positive EBITDA growth in our portfolio despite inflation and despite some messiness in the supply chain. It's going to have to come down. And the Fed seems absolutely committed to tightening financial conditions by raising rates and hopefully getting inflation under control. Just by what's baked into the cake, I do think inflation will come down. We're not seeing that broad-based across the portfolio, but in certain areas for things that were really hot, we are seeing the cost of goods starting to come down.